session. If you have any questions, just let me know while we go through the presentation. Okay, so we're looking at additional issues that deal with inventory. Chapter 8 dealt with what type of costs are we going to be including as part of our inventory. And then we also looked at the cost flow assumptions. In this case, now we're looking at other issues that deal with inventory. So how exactly are we going to measure this inventory and report on our financial statements? There are certain things that may affect its value, and therefore we need to take that into consideration. So different things that could happen. As we said before, the inventory could be damaged. There's a physical deterioration, especially here in Guam, because we have a hot and humid climate. The inventory may become obsolete. That's why it's important to assess the inventory turnover, how many days do we keep our inventory, etc. Because we may need to take action and do things so that we can expedite the sale of that inventory. And then changes in price levels, especially now where we have these rising costs due to COVID, which disrupted a lot of the supply chain, which is gonna, I don't know, I read an article in the paper a few days back, or I think it was yesterday, something about rising costs on Guam. I mean, we're already deal with high costs. So you can imagine rising costs is not good news. And so all this is going to reduce our ability to sell this inventory. Or we may have to find other ways like, sell this inventory at discounted prices and things like that. So that means that if, our inventory is damaged, then it's going to lose its value. So the value that we're reporting on the balance sheet, it may be overstated. And so that's why we may have to apply certain techniques to make sure that we are reporting the proper amount or close to it. Because remember, in accounting, we are being conservative. We don't want to overstate our income or our assets. Okay, so one of these, we have actually two approaches to inventory write down. One is, oops, what did I do? One is the lower of cost or net realizable value. And this one, in the past, we only had option number 2. But we started having 2 options due to the convergence with IFRS. So IFRS uses the net realizable value. That's why we now have introduced this in GAAP. And then we have the old method, which is the lower of cost or market. And then you have the cost flow assumptions that go with the measurement approach, which is very helpful. And then how this is going to affect our financial statements. In essence, remember that we're being conservative, right? So if our inventory is overstated, we're gonna write it down. Once it's written down, we cannot reinstate it, okay? So we have to really make sure that we have analyzed carefully the inventory before we write it down. So we're going to look at the 2 methods. So the first method was the lower of cost or net realizable value. So net realizable value is basically defined as the estimated selling price less any cost, selling costs, okay, or cost of completion or transportation that has to do with selling that product. So the net realizable, so we're going to compare net realizable value and cost. If the net realizable value is lower than cost, then we are going to have to adjust our cost. So we're going to have to write down the cost of our inventory to match the net realizable value. If cost is lower than net realizable value, then we don't need to make any adjustments. We're good, okay? So hopefully we have an example here. When we're doing this analysis, you actually can do it by individual items. You can do it by category. So if we have, I don't know, different products like, I don't know, yogurts, and we have milk, and we have, so we can do it by different categories, or we can do it as a total, okay? So for individual items, we're looking at cost. Let me get the pencil. There we go. We're looking at our cost, and we're looking at our net realizable value. And so in this case, cost is lower than net realizable value. So, excuse me, we are reporting on cost. For item B, cost is higher than net realizable value, and therefore we are choosing net realizable value, and so on and so forth. We go through each individual item and we choose the lower of the two, cost or net realizable value, and then we add it together and we can compare this revised cost with the original cost. So that means that we will need to make an adjustment of $20,000. So we're going to have to credit inventory for $20,000. Again, we're writing down the inventory. All right. And when we're making this adjustment, we have to kind of see, is this something that is frequently made? Maybe we're doing this, I don't know, twice a year, this analysis, or every quarter, etc. So in that, if that's the case, then we're gonna use cost of goods sold. If we, it's very rare that we actually write down our inventory, but let's say due to COVID, we had some inventory sitting down for a long time. It got damaged. So this is a one-time deal. May not happen until who knows how many more years from now. Then we're going to be debiting loss on write-down of inventory. Okay, so we have to kind of assess our activities and then use a proper account. Okay. All right, lower of cost of market is the one that students get a bit confused. Actually, I think it's kind of fun. It's kind of like a game in a way. But for lower of cost of market, you have a ceiling and a floor, okay? And the ceiling is defined as the net realizable value. So it's going to be our selling price less any cost associated with selling that product, direct cost, that is. And then our floor is the net realizable value less in any a normal profit margin that we have for that product. So once that we have established a ceiling and a floor, we're going to be looking at cost versus market. Now, market in this case is the replacement cost. So if I were to replace this inventory today, how much would I have to spend? What would be my cost? So that replacement cost is the one that we're looking at. And then depending on which one is lower, then we may have to write down our inventory. So if our inventory is higher than the replacement cost, and the replacement cost is within the ceiling and the floor, then we may have to choose the replacement cost. Now I have an example, thank goodness, so that we can kind of see how is this supposed to work. So in this example, we are figuring out the net realizable value. We have our selling price, let's see, estimated selling costs. And then, so this would be our ceiling. And then to figure out the floor, we take this amount less a normal profit margin. Okay, so we have our floor. So once we have the ceiling and the floor, now we're going to compare our cost versus our replacement cost. Okay, so in this case, we have cost is lower. This is a good example because usually you guys get confused on this situation. We have cost. Okay, now remember that we can never ever write up the inventory. Okay, we can only write it down. All right, so cost is lower than replacement cost. Now cost is lower than the floor. But if we were to choose floor, then we will have to write up the cost, and we cannot do that. So in this case, even though cost is lower than the floor, we're going to choose cost. Okay, cost. Now we have cost and replacement cost. So in this case, replacement cost is higher than cost, and replacement cost is greater than the ceiling, but we can only go up to the ceiling, and therefore we are choosing ceiling here. Again, cost and replacement cost is lower. Replacement cost falls within the ceiling and the floor, so we're okay. So we take our replacement cost. Next one, cost is lower. Cost is higher than the ceiling, so we're choosing ceiling. Okay, again, we can only go down. Replacement cost is 92. Replacement cost falls within the parameters, and therefore we choose our replacement cost. Once that we have a total, then we compare this total with our original cost total, and that will be the amount, this gap here will be the amount of our adjustment. Again, if is an analysis that we do, frequently, we're going to use cost of goods sold. If it's not, then we're going to use loss on write down of inventory. Okay. All right. So that had to do with measurement, okay, the value that we're going to report on our balance sheet. Now we enter into different methods that we have to assess inventories. There's different situations why we would want to assess inventory without having a physical count. It could be because maybe we had a fire, some sort of damage to this inventory, and we don't know exactly how much was in the warehouse. So we have to assess an ending or estimate an ending inventory. It could be because perhaps we're issuing quarterly estimates, so we don't want to go, and count, have a physical count. We're just going to estimate the ending just to issue our, quarterly estimates or, budgeting or forecasting reports. Whatever the situation is, we have different methods. The first one that we're going to be looking at is the gross profit method. And what the gross profit method is, we are actually using our current sales to kind of estimate our ending inventory. Now we know that sales has a markup on cost, right? Because our sales price should always be higher than our cost. So in order to kind of assess our ending inventory, we're going to have to convert that sales figure, that retail figure, to cost. And we're going to be doing that by using the gross profit margin. Okay, and so our usual formula is we start with our beginning inventory, we add our net purchases, we have our goods available for sale, and then we subtract our ending inventory to arrive at cost of goods sold. Now, since we don't have ending inventory, right, because we said it was damaged, we have no idea, we're just going to switch this up. We know how much our sales are. Okay, maybe we have good records on the sales. And so we just need to convert that sales figure into cost and then figure our ending inventory as a plug figure. So an example, we have beginning inventory of 600,000, net purchases of 1.5. We have our goods available for sale. So all the inventory that we had on hand before it was damaged. Now we know that we have $2 million in sales, and we were given a gross profit percentage of 40%. So if we subtract this gross profit percentage, we would arrive at this estimated cost of goods sold. Okay, so we have converted our retail sales to a cost. Okay, cost of goods sold, and then we subtract that from our goods available for sale to arrive our ending inventory. It's an oversimplified way to estimate ending inventory. Issues with this is that you may have different items that have different gross profit percentages. So you may have to break this down into the different items with the corresponding gross profit percentage. So again, it's just a rough way to estimate. Maybe for insurance purposes, you need to estimate, your ending inventory. Then you can use that method. Another method is the retail inventory method. This is more like an average that we're using to estimate, again, ending inventory. So let me just show you the example. So for example, we have our beginning inventory at cost and retail, plus our net purchases at cost and retail. Do we know what's net purchases? What's net purchases? Right, it's our purchases, less discounts, less returns, right? Exactly. So I just want to make sure that we're all on the same page here. And so that will be our goods available for sale. And we have goods available for sale at cost and retail. Now we can take sort of like a blended rate. Okay, if we divide our cost divided by retail, we have some sort of blended rate here. And we have the amount of sales again. So if I subtract sales from our retail goods available for sale, I arrive at a retail inventory, okay? And so if I multiply the 160,000 by the 62%, I kind of have an ending inventory at cost, okay, like a blended, an average. And then from there, I subtract that from our goods available for sale at cost, and I arrive at a cost of goods sold. Okay, so if I need to estimate my ending inventory is here. If I need to estimate my cost of goods sold is here. Now, this method can be a little bit more complex if we start considering markdowns in markups. Okay, so let's say, for example, that I'm selling a t-shirt, and this t-shirt is selling so well that I decide to mark up this t-shirt to $10, and then keep selling well, so I'm gonna mark it up for Christmas to $12. All right, now after Christmas, no one is buying it for $12, so I'm gonna have a markup cancellation of $1.50. I can also have a markdown. Okay, so markup is when we raise the price. Basically, markdown is when we bring that price down. So when we are calculating this ratio, there's two sub methods for the retail inventory method. One is the average. So with the average, we're gonna include net markups and net markdowns. And with the other method, we're gonna exclude the markdowns. So again, we have our home improvement stores, and we're using the retail method average cost. So in this case, we're including our net markups and net markdowns in our calculation of the ratio. Okay, so note that these markups, net markups and net markdowns, are on the retail column, and then we calculate our ratio, and then it's the same calculation. We take our net sales at retail, subtract from our goods available for sale at retail, to arrive our ending inventory at retail, and then multiply that 198,000 by the 64% to arrive at our ending inventory at cost. And then we have our estimated cost of goods sold at cost. So that's the average cost method. So retail inventory method, average. And then we also have conventional. With the conventional, we're only including net markups, but we're not including net markdowns in the calculation of our ratio. Okay. And so the net markdowns, we do take those into consideration, but after calculating the ratio. So once that we have calculated the ratio, then we subtract our net markdowns from our retail column here to arrive at our goods available for sale. Then we subtract our net sales at retail. We arrive at our ending inventory at retail. We take this 198,000, multiply it by the 63.2% to arrive our ending inventory at cost. And then we can calculate our cost of goods sold. So that's basically what you have to remember for the retail inventory method. So there's an average and there's a conventional. For the average, we include both net markups and net markdowns in the calculation of our ratio. For the conventional, we are only including the net markups. We are not looking at the LIFO retail method since we didn't actually look at, well, we did look at LIFO, but we'll just go ahead and scratch this one out. I think the rest of the chapter, because dollar value, we didn't actually look at dollar value in chapter 8. So there's no point in looking at dollar value now. So this should make your life a lot easier. I just want to see if there's anything else that we need to talk about. Oh, we're not actually going to go into change in inventory because this is change in accounting principles, which you're going to be looking at in 301. Change in accounting principle is from one accepted accounting principle to another. So this will qualify for changing accounting principle, which means that we're going to make a retrospective treatment. So that means that we have to restate previous years to make be able to make comparisons, right? We cannot compare FIFO in one year to LIFO in another. We're going to have to restate. So there'll be an adjustment to retain earnings and inventory. You don't need to worry about this. This is just FYI, since I know you're going to be looking at this in more depth next semester. So something fun to look forward to in a few months. Well, you have a long summer, so, right? Yeah, summer. Let's see. We also have inventory errors. I think you're also looking at errors next semester as well. So I'm just brushing through this. Basically, your inventory could be overstated or understated. It could be due to maybe a mistake in physical count, a mistake in recording purchases. Usually, these errors are counterbalancing errors. What that means is that probably within 2 years, the error is going to self-correct. But if the error is material, you're going to have to fix it as soon as you discover the error. Okay. And of course, when we fix it, if the books are already closed, then we're going to have to either increase or decrease retained earnings. All right, purchase commitments is another one that you don't need to know. This is just FYI. Purchase commitments is when we actually make a forward purchase. We are purchasing something in advance at a fixed amount on a fixed date. And so it's going to affect the journal entries when we actually have that item and the fair market value of the item differs from the fixed amount that we have in our contract. So sometimes if the market price is lower, we are going to have to recognize a loss on the purchase commitment. Okay, so that's pretty much it. Again, we're not looking at purchase commitments. So this should be a fairly easy chapter. Again, I think the items that you need to focus on would be the two methods for estimating inventory, which was the lower of cost or market and the lower of cost or net realizable value. So you need to know that. And you also need to know those methods to estimate ending inventory, the gross profit method and the retail inventory method, the average and conventional. I think with that, you're pretty much in pretty good shape for this chapter. Does anybody have any questions before we leave? I think